All right, let's do another video update. Last week we were traveling, so we didn't do an update. It's been 2 weeks. The world's exploded since then, so let's catch up, starting with dollar. So dollar relative sentiment is bullish, and the dollar took it on the chin last week. It was a combination of the Bank of Japan raising interest rates and therefore crimping the so-called carry trade, unwinding that. It was highly levered, and people were selling risk assets they had bought, from borrowing in yen. And then we had the jobs report on Friday, which possibly showed that the U.S. might be heading towards a recession. The labor market has seemingly deteriorated enough that we might be on the precipice or moving towards a recession. So the combination of those two things, and also possibly Jerome Powell's reluctance to say that September was a definite in terms of a rate cut. So on Wednesday, when the Fed had its meeting and Powell had its press conference, he's been dovish, since last December. In the spring, whenever inflation was still a little bit on the high side, he went out of his way to say that the next move by the Fed was likely not going to be a hike, and it was almost certainly going to be a cut. Even though at the time inflation looked like it was ticking up again. So he was dovish, but then last week, when given the opportunity to acknowledge that yes, it's time to cut rates and that September is when they will start, he was very coy about it and basically said that September, wasn't a done deal, it's still up in the air, who knows. And so I think that nonchalance and reluctance to commit to cutting rates, coupled with the Bank of Japan raising interest rates, coupled with the weak jobs report, really did a number on investor sentiment, and the market sold off. So with the dollar, you see it had this big drop on the jobs report. But if you look at how the dollar tends to trade, when it has these vertical moves, whether up or down, it tends to retrace them. So back here in November of 23, had a big drop, and then had another big drop in December whenever the Fed pivoted. But sure enough, at the end of December, it bottomed and it retraced most of that drop from November, and then into April it retraced more than all of that drop. So now we've had this big drop Friday and Monday, and the last couple of days it started to retrace that drop. Dollar relative sentiment is bullish. The smart money sold the dollar last week on a relative basis, but dollar relative sentiment remains bullish, and it will stay that way at least until mid to late September. So there's at least another, I'd say, 6 weeks where dollar relative sentiment is going to be bullish. So we'll get to see whether or not it retraces the recent drop and kind of lives up to its bullish tilt at the moment, or whether it's going to be way behind and the market really fixates on a potential recession and the dollar keeps dropping. So we'll have to see how that evolves. Now, what happened Friday and Monday could have been an overreaction. I saw 2 tweets today from Jim Bianco, and he made 2 interesting points. One is he said that if you look at investor newsletter sentiment in equities, its drop, it was at 64% last week, and then after the recent fall in the equity market, it fell into, I think, the 30s or 40s. And that drop is one of the biggest on record back to the 1987 stock market crash. Yet the market, the S&P 500, only fell 8%. And yet the sentiment drop was in line with the COVID drop in equities. It was in line with the 87 market crash. It was in line with Lehman Brothers going bankrupt, and what happened with the equity market there. So it's possible that the investors have overreacted, and once the market takes a deep breath, it might realize that, okay, maybe we aren't sliding into a recession just yet, and maybe they'll move back a little bit towards the soft landing narrative. Another interesting data point, and I think this is quite interesting, is that if you look at where the 10-year yield was before Friday's jobs report, it was at like 3.9. And then the jobs report came out, there was panic, rates dropped, and then rates dropped again on Monday big time, and the 10-year yield hit, I think, 3.65%. But as of midday today, and as of right now, it's at 3.92%, which is above where it was right before the jobs report. So if everyone is worried about a recession because of the jobs report, 10-year yields are actually higher than they were right before the market knew what that number was. So those are some things to take into consideration. The market may have overreacted. We might get a little bit of a breather here. Markets might rebound, dollar might rebound, equities might rebound. So we could see a potential retrace of this drop in the dollar, as we have with pretty much all of the big vertical moves in the last year plus, and probably dating back much further than that. So that's the dollar. Let's move on to gold. So gold, the positioning environment is unfavorable for gold. Gold relative sentiment is bearish, silver relative sentiment is bearish, dollar relative sentiment is bullish, and euro relative sentiment is bearish. Gold and silver tend to like when the euro's bullish or the dollar's bearish. Right now, neither of those things is the case, and both gold and silver relative sentiment, individual relative sentiment, are negative, and they actually got a little bit worse last week. So the positioning environment is doubly unfavorable for gold, and it's, historically gold tends not to do well, but the data history that we have dating back to the 90s doesn't really cover a secular environment like the one we're in now. So the secular environment that we're in is one where we're in a bear market in equities driven by high inflation. And in that type of secular environment, gold is a coveted asset. And it will probably, as I've mentioned countless times, literally every week in the newsletter since we started writing it 2 years ago, that gold is likely to be one of the best performing assets for the duration of this secular cycle, potentially one of the few that will give an investor positive real returns, because most other assets, bonds, equities, are likely to have negative real returns given where they're currently priced. So gold, the fact that it's been moving sideways and not up speaks to the fact that the positioning environment is unfavorable for gold. But the fact that it hasn't really moved down aggressively speaks to the fact that we are in a secular environment where gold is in demand. Central banks are gobbling it up, and we would expect it to rip once again at the very latest when the positioning environment turns favorable once again for gold. Now, it doesn't look like that is on the near horizon. It could take several weeks and potentially even months, given where relative sentiment is in those various assets that I mentioned. But we'll see. A few weeks ago, the institutions had been buying gold, but in the last few weeks, they haven't on a relative basis. Gold might have to fall, actually, just to compel retail traders to give it up and sell it so that institutions can buy it, and then we might get more of an updraft. But the fact that it's been holding relatively strong, again, speaks to the secular environment that we're in. If we look at this composite chart here, so the red periods are when when composite gold relative sentiment has been bearish. The last 3 times that it's been bearish, here gold moved sideways, slightly up, then it moved up, and now it's kind of moving sideways, slightly up. So really speaks to the environment and how gold is likely to be one of the best performers. Silver, on the other hand, has gotten the memo that the positioning environment is quite unfavorable for precious metals. So composite silver relative sentiment, which is the same as composite gold relative sentiment, turned bearish where this arrow is here when SLV, the silver ETF, was at 27. It's now at 24.33. So that's more than a 10% drop. So silver is definitely responding to the fact that the positioning environment is unfavorable. But again, silver is more volatile than gold, and it might actually be a better performing asset than gold when all is said and done in this secular cycle. So I wouldn't write silver off, and it too will likely rip once the positioning environment turns favorable again. Here we have a similar chart for silver. You can see, when it turned red recently, it's lower than when it first turned bearish. So it's actually responding to the relative positioning. If we look at TLT, now this is quite interesting, long duration bond ETF. This red line here corresponds to a 30-year yield of roughly 4.45%. And as you can see over the last several weeks and months, TLT has had a hard time staying above that red line, which means that the 30-year yield has had a hard time staying below 4.45%, which makes sense given that there probably should be some type of term premium. If T-bills are going for 5.25%, you would expect maybe the 30-year bond to be higher than that, but we had a negative term premium. But at the same time, it wasn't going much below 4.45%, and it really couldn't sustain until the past 5-6 days where fear exploded, fear of a recession, and TLT exploded above that line. But as you can see, and where it peaked was where the 30-year yield corresponds to roughly 4%. So that blue line is where the 30-year yield is at 4%. So 30-year yield bottomed at 4%, and it's given back half of its gains. So it's now at 4.225%, which is essentially halfway between 4 and 4.45%. So rates falling is a first order effect of recession fear. So if people were scared of a recession, let's buy long duration bonds. Those have historically been safe havens during certain secular cycles, but not necessarily in secular environments driven by high inflation. And given the US fiscal situation, the second order effect of a recession is very bad for long duration bonds because, one, if you get a recession, equities fall. That means capital gains taxes fall. Two, you get rising unemployment, so there's fewer people paying income taxes. So income taxes fall. So the totality of taxes falls, but spending doesn't fall. In fact, it probably increases because they want to stimulate the economy. So if taxes fall and spending increases, deficits blow out, and deficits are already 7% of GDP. So in a recession, they could go as high as potentially 15 or even 20% of GDP, depending on how bad the recession is and how much they increase spending. Now, right now, they're essentially issuing mostly T-bills to fund the U.S. government. 80% of our debt that we've been issuing lately has been short duration and T-bills. But if you keep issuing mostly T-bills, then you keep having to roll over more and more debt every year. And eventually the amount that you have to roll over every year basically is too much for the market to handle supply-wise. And so you have to start putting some of that long-term, some of that debt that you're issuing out at the long term, so you don't have to keep rolling it over every year, and you have 10 to 30 years before you have to roll it over. But if they do put that much supply at the long end, it's going to put upward pressure on rates and likely cause rates to soar unless the Fed steps in and suppresses them by buying those bonds and doing yield curve control, which would then allow inflation to become unhinged, and then the wheels will fall off the cart. So the first order effect is buy long duration bonds, but the second order effect, if we're really going to have a recession, is that those rates should rise. So we'll have to see how things play out, and how they play out could give us a read on what the market really thinks about whether we're heading for a recession or not. At the moment, composite relative sentiment for long duration bonds is bearish. It's tended to be a very good predictor, but what happened in the last week or so was an abrupt narrative shift, and how composite relative sentiment is constructed, it tends to be a little bit slower moving than something that changes on a dime. So we'll have to see if it's offsides or whether the narrative will shift back in the direction of what composite long duration relative sentiment for long duration bonds was telling us. Here's a chart of that. I say this all the time, the red tends to go down, the green tends to go up. Here we're red, but as we saw recently, long duration bonds have soared because of those recession fears, but they've given back half of their gains. And if we truly are having a recession, there's likely going to be a lot more long duration bond supply, and that won't be good for long duration bonds. So let's move to crude oil. Crude oil is also interesting. So we're in a secular environment where commodities should do very well. Secular bear market in equities driven by high inflation, but secular bear markets in equities tend to correspond to secular bull markets in commodities. come on. The oil bottomed in April of 2020. It went negative, and then it's been up hugely since. But then, since Russia invaded Ukraine, it's essentially been consolidating, coming down. A lot of that's been because the Biden administration was selling oil out of the Strategic Petroleum Reserve to keep a lid on oil prices, to keep a lid on inflation, because they needed to get rates down because the U.S. fiscal situation can't sustain higher rates. So it's not a pretty picture if oil does sustainably move higher. Now, it's at a level, it's at 75 now, roughly. It was in the low 70s earlier this week. And below 70, I've read where shale production in the U.S. becomes uneconomic. So that, if oil does go below 70, you might get some U.S. production shutting off, which will then lower supply, which should then be an upward force on prices. If you look at this technically, it looks like it could be in a descending triangle, which means, hey, maybe it does move lower. But you also have geopolitical tensions heating up again, which should also put upward pressure on oil. And what's a little bit suspicious is that if you look at crude inventory draws the last 5 weeks, they've all been draws as opposed to builds. So there's been a negative change in the inventory, despite the fact that some of those weeks they were expecting builds. But the last 5 weeks, there's been a negative draw each week, and each week the draw has been much bigger than expected. So if they've expected a draw, the draw's been much bigger, and in some cases they expected a build and they got a draw. So typically you would expect oil to have, some upward pressure because of that unexpected draw in the inventory, but we've seen oil just keep going down. A few weeks ago, when Biden was still in the race, the White House said, hey, we can still sell oil from the SPR when oil was at 80 to get it lower, heading into the election. Maybe they're doing that. I don't know. It does seem a little bit strange that tensions are heating up again in the Mideast, and we've had all these draws in the crude oil, yet crude oil has been going lower. Now, that could make sense if we are truly headed for a recession. Well, then, that could be the tell. So we'll have to see how things evolve with oil, but commodities in general should be, alongside gold, one of the better performing assets throughout the duration of this secular cycle, which is likely going to last at least until the end of this decade, if not into the next decade. So here we have the NASDAQ. Now, equities, the picture is a little bit murky, and so I just have a chart of the NASDAQ as opposed to having multiple different equity charts. So let's just talk this through. Now, it's quite interesting that this really did top at the 1.618 Fibonacci extension of the distance from the previous all-time high in late 2021 and the low in October of 2022. It doesn't get any cleaner technically than that. And then it bounced right on this trend line from the lows in 2023 up through the October low in 2023, etc. So now, where do we go from here? Well, where can we start? So steep sell-offs, they tend to chop around. They tend to, maybe have initial bounce, but then they kind of chop around, and then usually they go back and retest the initial low. Sometimes that happens in a couple weeks time. Sometimes it happens over a period of months. So Monday's low could be retested relatively quickly, or maybe in several months to come. So that's one thing to look for. Another thing is that the clock seems to be ticking on this equity bull market. So at the high recently in July, this is NASDAQ, but the S&P also had a high, roughly around the same date. Valuations were the second worst, the third worst that they've ever been. The worst being the peak of the dot-com bubble, the second worst being the peak of the everything bubble in late 2021, and the third worst being middle of July this year. But middle of July this year was pretty much right at the everything bubble level. So really it was likely the second worst equity valuations of all time. So even if we do bounce and the market says, okay, we overreacted, we're not heading for a recession, and therefore the market should be trading back near the highs. But again, you're running up against valuation limitations where it doesn't really make sense to own equities there given those valuations, because those valuations have historically correlated with extremely low forward returns over the next decade. And those returns are almost certainly going to be less than inflation, where equities are priced. So all this is to say is that if the market does rebound here, it's not likely the start of a new secular bull market. It's not likely the start of a new cyclical bull market or the continuation of a long-term cyclical bull market. We seem to be in the later innings. We're almost certainly in a secular bear market driven by high inflation that started at the end of 2021. And we're currently in a cyclical bull market, and it seems to be that we're in the later innings of that cyclical bull market. Whether we've already topped, I don't know. Whether we bounce and make new marginal highs sometime in the next few months, maybe early in 2025, again, not clear, but there doesn't seem to be a whole ton of upside left for equities. And so if we do rally strongly from here, it could be a good time to strategically lighten up on equities, because we might get a real rug pull, that comes out of the blue because of, who knows, inflation picks up again, Nvidia has negative sales growth, there's some type of escalation between Israel and Iran, or Russia and NATO, and then China jumps in and we have a world war. And then there's commodity shortages and food shortages and ammo shortages in the US because we don't have the industrial capacity to actually make anything anymore. So things could get really ugly and there could be a big rug pull. So if the market does rally, keep your head on a swivel and be prepared to lighten up your equity exposure, because this bull market really isn't long. It's long in the tooth and it doesn't have much life left, I would say. I would probably give it until at most, say, the middle of next year. But again, we could have already topped, and if the market does fixate on a recession, we could be going much lower from here. Now, the jobs numbers on Friday, were they really that bad? I've seen people say that it was a function of temporary layoffs due to weather, and those temporary layoffs were much higher than the average temporary layoffs due to weather. And so it could just be a one-off, and others also chime in that it was because of new entrants into the labor force and not because of permanent job losses. So that's a positive spin on the Friday jobs report, but I've also seen people refute that positive spin by saying that in the past, when the Somm rule has been triggered, the Somm rule is named after Claudia Somm, an economist who discovered that, hey, every time the unemployment rate has risen by more than 0.5 percentage points above its 12-month minimum, that has been a precursor to a recession in the history of the unemployment data time series. So every time that we've had that type of rise, we've had a recession, and people have said that when the Somm rule has been triggered before, the workforce has always been increasing. So the fact that we've had new entrants into the labor market is not really an excuse for why the unemployment rate has increased. And Claudia Somm herself also thinks that we could be in trouble in terms of heading for a recession. But at the same time, she tends to be a little bit partisan politically and might be saying that to try to induce the Fed to cut rates to juice the economy and equities heading into the election. So I would take that assessment with a grain of salt. When Biden hadn't pulled out of the race and the Somm rule was on the verge of being triggered, she kept saying, no, we're nowhere near a recession. Now that he's out of the race and it has been triggered, she's saying, yes, we are headed for a recession. So again, it could be something where she's saying that to get the Fed to do something that might help the Democrats. Now, the Bank of Japan essentially was chastened by what they did and what they caused in markets. Maybe they got a call from Jerome Powell, and maybe he wasn't happy, or Janet Yellen. Of those two, probably Janet Yellen. And they said that they will refrain from raising rates again while the market is unstable. As Zero Hedge chimed in after that, saying that the market will never stabilize because of that, and the Bank of Japan will never be able to raise rates again. So because they've indicated that they won't raise rates until the market stabilizes, perhaps you see people jump back into the carry trade. Who knows? Now, with respect to relative positioning, institutions in the last few weeks have been selling equities strongly. And they've generally had a bearish tilt in their equity positioning since last September. So it's been almost a year that they've been bearish on equities. The equities have risen since then. And that is one of the reasons why you shouldn't just look at how they're positioned in equities. You should look at how they're positioned in other assets as well. And if you look at how they're positioned in other assets, they have been and continue to be quite bullishly positioned on a relative basis in other assets, currencies, commodities, fixed income, etc. So there's some internal tension amongst the indicators that make up our composite equity relative sentiment index. Yet on a net basis, it's still solidly bullish. In fact, it's at a level where the market tends to have a Sharpe ratio over 1 and tends to annualize around 20% returns. However, it's hard to say. Typically, composite equity relative sentiment leads narrative shifts. So if you look back in 2022, well, actually, if you look back to late 2021, in early 2022, composite equity relative sentiment was bearish, yet the market was at an all-time high and everyone thought it was only going higher. But composite equity sentiment kind of led that change in narrative from, oh, we're going to the moon, to, oh, the Fed's raising rates, things are going to get bearish, the market falls. And then as the market fell, composite equity relative sentiment got bullish in June, and most stocks actually bottomed in June as far as like the equal-weighted S&P and broad equity indices. But the S&P 500 bottomed in October, and as did the NASDAQ. So composite equity relative sentiment turned marginally bullish in June, and then it turned ridiculously bullish in October when the indices actually bottomed. Yet at that time, everyone was resoundingly bearish. Goldman was like, hey, you sell any bounce, we're headed for a recession, we're going much lower. Yet that was the bottom, and we're up hugely since then. And then if you look at when Silicon Valley Bank collapsed in March of 2023, March 10th, everyone was bearish. The equity market was essentially flat on the year. It had been up 8%. It had fallen maybe 6-7% after Silicon Valley Bank, so it was almost flat, still marginally higher on the year. But composite equity relative sentiment jumped to 100%. So it was basically telling you this is the best time to buy equities in 2023, and of course the market rebounded hugely from there. Now, market sold off steeply, yet composite equity relative sentiment marginally increased last week from 73% to 76%. So it's hard to say whether this narrative shift that's changed from a soft landing where inflation's coming down, growth is robust, yet the Fed will be cutting rates, to one where we might have a hard landing because composite equity relative sentiment didn't lead this narrative shift. This was something that happened really quickly, and composite equity relative sentiment probably won't react, for weeks potentially to what just happened. So it'll be interesting to see if the market fixates on, yes, we're having a recession and we just keep going lower from here, or whether the market says, well, maybe we overreacted, maybe, the jobs data isn't as bad, maybe growth is still fine. And if you look at the Atlanta Fed GDP, it's at 2.9%. If you look at Goldman Sachs' estimate, it's at 2.6%. So maybe growth is still resilient, and maybe the market kind of catches its breath and bounces from here. But again, if the market does bounce, the bull market, it probably doesn't have all that much longer to exist. So we're in the later innings, and time seems to be running out. Now, tomorrow's initial claims will likely be scrutinized heavily. If they're bad, the market probably goes down, and that might help the market really gravitate towards the recession narrative. If they're not so bad, then the market might say, okay, we overreacted, and we might see a multi-day, perhaps multi-week bounce. It's notable that today, all the broad market indices, the S&P, the Russell 2000, the NASDAQ 100, they all triggered a short-term mean reversion signal where they essentially finished at their lows of the day. Of their daily range, they finished, within 10% of the low, and pretty much at the low, well within 10%, probably within 1 or 2% of their daily low they finished within. And that tends to mean that over the next 3 to 4 days, those equities, those indices will bounce. So that might be some foreshadowing that the initial claims data might come in benignly tomorrow, where the market doesn't, say, oh, we're definitely having a recession. They might just say, okay, better than feared, and maybe we get a big rally. I don't know. But we will have to see how things evolve. Because of the really abrupt narrative shift, it's hard to say sort of what the relative plays will be. Will small caps outperform large caps? Will growth outperform value? Will consumer staples outperform consumer discretionary? It's hard to say because given the abruptness of the narrative change, it's not easy to say whether that narrative change is going to stick or whether it was just an overreaction and the market drifts back to the old narrative. So we probably have to give it, a few days or a few weeks to see how things shake out and get more economic data to see whether or not a recession really is in the cards. I'll be looking at that. I'll be looking at how the positioning evolves in the various macro assets and equities. And I'll be writing up in the newsletter every week and doing these videos hopefully on a weekly basis. So, thank you for watching. That's all I have today. If you have any questions or comments, leave them in the chat. And until next time.